Glorious Monday afternoon. It is glorious because baseball is back and the Rangers are in the playoffs. It's Monday, April 11th. I'm Guy Adami. I'm always joined by Dan Nathan for Market Call. In just a few brief moments, Carter Braxton Worth of Worth Charting will be joining us. Today's episode brought to you by FactSet, financial data and analytics powered by Tomorrow. And of course, the good people at Open Exchange, because they manage the virtual meetings that matter for the top companies around the world. Got to tell you, what a difference a day or two makes, Dan Nathan, because now all of a sudden everybody's getting a little negative on the broader market. How are you, Dan?
I'm doing well, Guy. I'm happy for your Rangers. And you know what? Your Yanks, they did just fine. 2-1 over the weekend against their arch rival here. But I know, you say, just wake me up when September comes here. Here's the deal, Guy. It's not just what a difference a day makes. Really what's happened over the last week as far as, the relative underperformance of the NASDAQ is pretty striking. And I'll just say this, as we get into earnings season here, we're going to talk about banks that are going to report towards the end of the week. I think that the setup in the banks was really bad. The setup in the tech stocks that were raging off of those March lows, just a week ago, that's going to be a really, really dicey one. And then today, the things that kind of catch my eye a little bit are some big cap tech stocks that have had analysts either downgrades or negative notes about them, right? And they're trading really poorly. Like, to look up at your screen and look at Microsoft at its lows today was down 4% off of a UBS negative note about growth. I mean, what does that say to you, Guy? This stock's down 15% on the year. This is the second largest equity in the entire market.
I think Microsoft's the most important company in the world. That can be debated, but in terms of what it means for the broader market, it's extraordinarily important. And you look at this chart, Microsoft made a new all-time high, I want to say in mid to late November of last year. We're in the middle of April now, so you could see how poorly it's traded since. Yes, you got the bounce with the rest of the tech names a few weeks ago, but it's giving it back now. I mean, this is one of those battle line stocks that you have to look at, and we're getting into, I know we talked about it last week, but we're getting into the Top Gun danger zone right here, somewhere between sort of 250 and 275. And I got to tell you something, a downgrade, but probably the first of a few to come. I think people are starting to question Microsoft a little bit on valuation. When valuation matters, no company is impervious, Dan Nathan.
Yeah, and I guess the other point is when you look at it, it wasn't even a downgrade. It was just a note signaling that you might see slowing growth. And there's 47 analysts that rate the stock a buy, 4 rated a hold, and none have it a sell here. So that's what I meant about a really difficult setup from a sentiment standpoint. We know how crowded many investors are in that. When you think about, the current fiscal year, 2022 that they're in, expectations are for, mid-teens EPS growth, both this year and next, and the stock trades about 30 times and about 27 times next year. That's kind of expensive. We made the same case looking at Apple, much lower expected growth, both EPS and revenue growth, and that stock trades with a high 27, 28 PE there. And when you look at this thing, and I know Carter has had some thoughts on this over the last few months or so, it is a beautiful uptrend. It's shown great relative strength. That's the Apple here, but it never confirmed a new high right there. I think that's pretty interesting. Had that really sharp bounce off of that uptrend line, but it really does seem like those March lows are in the crosshairs in the near future, Guy.
158 to 200-day moving average, that trend line's in place. This chart to me actually looks worse than the Microsoft chart, believe it or not. Again, made an all-time high. I want to say, mid to late December. Sold off in a meaningful way, bounce, and now you're in the midst of the sell-off again. I think that trend line is in play. Trend line probably comes in around 152.5, 153, but I will tell you, I still think the October lows were about 138. I think that's your ultimate objective, and we'll see where the S&P is if and when we get there, but something to also look at. The other thing I think you have to look at are the triple Qs, because everything's sort of, we talk about those huge stocks. They're such huge components of the triple Qs. Well, traded right back to the 200-day moving average, bounced up to that level, rolling over again, and that danger zone for the triple Qs, you can see where it comes in, somewhere probably between, 315 and 325 or so, Dan?
Yeah, and I think it's really important just to kind of consider back in January when we were getting Q4 earnings. I mean, a consistent theme was that pretty good quarter, backward looking, decent guidance was not enough in that market, right? When we got into kind of late January and the market was kind of heading lower. And so to me, I think that those levels on the cues that you point out are really interesting. The S&P 500 in March did not make a new low from September, but the NASDAQ 100 did. And it tells me that maybe, just maybe, a couple high profile disappointments and you are on your way back to that. And speaking of a high profile disappointment, Guy, gotta look at this NVIDIA. Baird downgraded the stock today, and you haven't heard a lot of downgrades in NVIDIA of late here, but look at the SMH, the ETF that tracks the semiconductor index. Obviously, NVIDIA was a huge part of its outperformance last year, but look at this thing, man. It did make a new low from its February lows. It had a 20%, I think Carter called it almost to the penny over a month ago, had that massive ricochet, and now it's given it all back. What do you think of when you see a sector like this that is driven by a very expensive stock or two? Now, obviously, Intel and Taiwan Semi, two also very large components that have not been participating, not expensive, but when NVIDIA and AMD are kind of driving the train on this thing, and they've given a lot back, especially after that Micron report a few weeks ago, when they actually seemingly put up a good quarter in guidance, and the stock has reversed 20%.
It's important. Obviously, Taiwan Semi is the biggest component of the SMH, I think a little north of 10%. NVIDIA being second, around 10%. Then you have about 3 or 4 names, Intel being one of them. I think ASML is one of them as well, around 5%. I bring that up because that bounce in NVIDIA, I think it was on March 14th-ish. The stock traded down to 203, reversed on big volume. We talked about it on Market Call that day, and I know we talked about it on Fast Money. We said, here's the reversal, play it for a bounce. I actually thought it would get back to sort of 275. It overshot. I think it got close down to 290 or so. Now we're giving it all back. This does not look particularly good, especially when we have a 200-day moving average that's flattening out and potentially rolling over. So keep an eye on this SMH for sure. I think it's important. Obviously, NVIDIA, a huge component, but Taiwan Semi as well. We'll see what happens, but I think we're going to give up the ghost a little bit here in the SMH, Dan.
Yeah, so a couple things. Obviously, a lot of market participants are keeping an eye on high growth or high valuation tech, but they're also keeping an eye on energy. This has been a story, Guy, that you've really kind of nailed. On each kind of pullback that we saw in 2021, you were a buyer. You were talking about the supply-demand, dynamics and the lack of investment and all that sort of stuff well before we really had this situation with Russia and Ukraine here. And so you'd been a buyer on dips. You had that absolute blowout. It was near parabolic move, right? In the start of March or late February or so, in crude from 90 to 130. Well, here we are, Guy. We've broken this uptrend in crude here. And I'm just curious what your take is. Are you waiting for a bit more to the downside? And to be very fair, I think viewers of Market Call know that you called for that quick move. You also said I'd be taking profits up there.
I thought it would hold the trend line, though, on the way back down. And it did the first time. Obviously, we saw the bounce, but the bounce was, we were unable to take out that blow off top. And now here we are. That's the right trend line. So you say to yourself, okay, is the 200-day moving average in play? And quite frankly, it looks like it will be. With China slowing down, shutting down cities, obviously what's going on in Europe, we've talked about it a long time. Demand is such a huge component of the crude move, but demand might be waning in the near term, so we'll see. I think 82 or so is the 200-day moving average. You've seen it before, Dan. You know how quickly we can get there. So kudos to you for calling a break of this uptrend line, and I think it happens. So you asked me, how do you trade it? I'll tell you exactly how. I think you're in no man's land here. I think you get back into equities in terms of energy equities on a break back above that uptrend line, and that will come in probably around 103 or so in WTI.
Yeah, it's interesting that you mentioned, those moves that we had based on demand. And if you go back and look at 2021, and we had 20% peak to trough declines at least in Q3 during the Delta variant. And then we had Omicron in the fall. And now we're seeing this similar sort of pullback with what's going on with China here. And I like the way you're thinking about playing it. I just wanted to kind of break some stuff down here. I mean, one of the ways that a lot of Market Call viewers or equity, investors or traders may look at oil, if they're not trading the futures, they might consider ETF that tracks the price of oil. One of those is USO. We have a chart here. I put a couple lines on it, man. This one looks like the hungry alligator. I think you coined that. I coined that years ago, and you made fun of me for that. But it's sitting right on that 50-day. It's broken that uptrend. And to your point about the crude chart here, you look at that breakout level from a couple months ago, from the peak that we saw in the fall into Omicron. Could that be a level with the 200-day moving average down there? Certainly. Okay, if things were to really slow down a whole heck of a lot. I just wanted to kind of show viewers a chart of the implied move in the USO over the next month and how we're going to figure this out here. If we look at the USO, you look at this blue line here, that is the implied volatility, the price of USO options. You see that white line, that is the historical volatility. You see that spread. What's really interesting to me was when crude was at its highs, the price of options were much higher because we had investors or traders reaching for calls or call spreads in the USO. Now that the prices come in, you've seen the options prices come in, but the volatility is still fairly high. That could signify that option prices look cheap if you want to take a directional move in the USO. And one way to figure this out, it's kind of a back of the napkin sort of situation. With the USO trading just below 72, you look at the May 72 straddle. That's basically the at-the-money straddle. It is the combination of the put premium plus the call premium at the same strike. And they're basically around the same price, about $4.50. So if you put the straddle, if you put it together, that's $9. That would be basically, if you bought that and you were not picking a direction, but you thought we're going to have a lot of movement, you would need a rally of at least $9 to the upside or a decline of $9 to the downside just to make money on the implied movement of about 12.5% between now and May expiration. But if you wanted to define your risk and pick a direction, it would cost you $4.50, basically the call or the put, which is about 6.25% in either direction. And I just wanted to kind of lay that out there. That's still kind of expensive, but if you're taking a view at how much the underlying is moving and where option prices have come in from, if you have a strong directional view, this is one way to do it with defined risk.
I like that sort of betting red and black at the same time at the roulette table effectively, but I know that's not what's going on. But you know what is going on? I mean, the guy that does, while I'm sitting back and watching Yankee baseball, hanging out, just sort of enjoying myself, this guy is going through hundreds, if not more, charts. Hello, Carter Worth. How are you?
Not to say that one endeavor is better than the other. But I did, as a child, not to say I put away childish things, I used to watch the Yankees, and Tom Seaver in particular. He was my vintage, and I love a good ball game. But to be fair, I was doing that while you were enjoying the Yankees.
I know. Well, listen, I mean, I'm not saying you're mixing metaphors, but of course, Tom Seaver pitched for the team across town. But yes, I will tell you, Carter, as you may remember, he won his 300th game as a member of the Chicago White Sox in the Bronx, in case anybody cares. But I digress. You've heard Dan and I talking about, I don't know, this hungry alligator. I don't know if you learned that in charting school, but it certainly looks that way. But talk to us about the S&P and what we were talking about at the top of the show, Carter.
Sure. And actually, just one thing on the oil, which is important, of course, that there's an arbitrage going on, right? If you look at Christmas 23, Christmas crude in 24, the contract is at or near the highs, whereas the front contract, the one we're looking at here together, has come off so substantially, 130 to essentially 92. And that's an arbitrage, when effectively the government has played that by releasing reserves, right? They are selling the near-dated stuff at a premium, and they know they can, in a way, fill it back up at lower prices. So here's the question about the market, I think, and just as you've drawn it, we have an up and close chart here. Gaps are important, and if you look at something that's going on right now, there's only one unfilled gap in the futures chart. You see them in the cash market because the market's closed, right? When a market is closed, you can get a shocking open to the upside or downside. It used to be a halted stock, and specialists on the floor would try to get a stock open. We don't have that anymore. And especially with the futures, which are trading almost 24/7, it's very rare to get a gap. Now, this chart here has no drawings, no annotations. Look at the next one. There is one unfilled gap, that blue line down at 4,400, 4,402. It's the only unfilled gap going back 5-6+ years in the futures. And it's a perfect head and shoulders, of course. And so we're on our way there. That's a rounding error that from today's open is about a 1% decline. But I think we're going there, and that's just a foregone conclusion.
Yeah, well, Carter, I mean, I saw your note overnight here, and you just said that's going to be an easy one, and you look at that, and you've drawn the lines, and we see that kind of head and shoulders formation. Talk to us a little bit, because I made a joke about this last week, and I think I remember a chartist telling me a very long time ago that left shoulder can have two bumps on it. Is that true? And then if we were to get through that 4,400 level, where do you think the measured move is to the downside?
That's right. So you can see here, you could say this almost has two right shoulders, right? There's one left and two right. And the point of all of it is it's the way a stock progresses when it's going up. That left shoulder is a setback, a dip, a correction from which it made a new high. And then when you're going down, you have counter trend rallies, just as you have counter trend sell-offs. At some point, though, you've reversed. You're no longer in an uptrend. And that's the issue here. Are we basically sort of flagging with downside potential? And then that brings up your question, which is so key. What is the downside? What's interesting, of course, is a measured move here is the width of essentially the head to the neckline where the gap is. And that projects down to essentially the lows of early March or late February, which would put us in a whole different circumstance for the chart of the S&P.
I agree with you, CBW. And, I've mentioned 4,000. I think I don't want to say it's a foregone conclusion because I've learned my lesson the hard way over the years, but I think 4,000 in the S&P is in the crosshairs. And I think you also know this. I mean, markets overshoot to the upside. They also overshoot to the downside a lot faster. 3750 for a lot of different reasons continues to sort of reverberate in my brain. We'll see. But this, I think, to your point, first thing we have to do is sort of see what happens at this 4402 level. You've said now a number of times you think the most important thing that's going on is in the form of yields. And let's take a look at interest rates, because this is a pretty interesting downtrend line. As you say, the lines, well, this in terms of this, the line drew itself.
It is. It's, if you think about it, it's the base on which all risk models for valuing equities, not to mention other things, are based on the cost rate of return. If you're going to do your CAPM model or your dividend discount model or your discounted cash flow, it has to be tied to some assumption on interest rates. And this is the 10-year yield chart. Now, to be fair, right, you can connect any 2 points. That's not a trend. You take any 2 points and connect them, meaningless. So we had 3 points in effect, and we essentially have broken above this line. But I think more interesting is if you look at this in log scale, and we have this next chart, and this, it hasn't touched 2 or 3, it's touched 5 or 6. This current rally leaves us to the penny up against the downtrend line in effect since Volcker peak. I mean, literally at 281, we will be to the penny. We're at 277 right now. So if we toggle quickly back and forth, let's look at arithmetic log, arithmetic log, arithmetic log. And basically the log is the better chart. And what it's saying is this is as critical a level as any. And maybe this is where we actually get officially the inversion in the yield curve. But it will be very important to watch the 2.81% level. We are very close.
All right, Carter. So, listen, you come on here, you lay some stuff out here, you explain some stuff. Last week, you did a very nice job doing the same on some formations, but talk to us as it related to the ratios, and we really appreciated that. And then I actually went stage right versus left on those shoulders, so thank you for correcting me here. But explain to our viewers why somebody would be inclined to use a log chart over the arithmetic, and then why this one is that important, or you can place any level of importance on one versus the other.
Yeah, and it's all fair game. There is no perfect answer. I try to look at arithmetic and log and look at all time frames. Some people say, well, why look past 5 years? Could there be any supply back there? Does anyone? Yes, there's people own stocks for decades, and when they break even, they decide to sell. It's the human condition. And so all time frames are valid and important and fair game. And so too is it with the sort of the construction of your chart, an arithmetic chart versus a log chart. We want to try to sort of tease out, to try to divine as much as we can by looking at as many different ways, just as a fundamental analyst might do price to book. And then he said, maybe I should look at the PEG ratio, or maybe I should look at enterprise value to EBITDA, or maybe I should just do tangible book, or et cetera, and so forth. Meaning people have all sorts of a sum of the parts model, right? It's all fair game, and same as it is with charting.
Sometimes things are obviously extraordinarily rate sensitive. Other names are not. You brought with us some, I think, 4 home builder charts that we need to take a look at. You've talked about this. I know you think there's some trading opportunities here. Speak to me, CBW.
Yeah, I think, look, sometimes you get overdone. Look at crude. 130 was overdone. Sometimes a crude negative $40 a barrel, it was overdone to the downside. Now, you can't just be a swing trader, a mean reversion only, because some of the best trades are sticking with trend. But when something is very extreme, it's right to not stick with trend and to actually play the other side. So take a look at a few of these charts, and we can try to figure this out together. This is simply a ratio. You can take anything and divide it by anything, and that gives you essentially a relative strength line or a ratio chart of one instrument to the other. So this is the S&P 500 Home Builders Sub-Industry Group, and its performance relative to utilities with the 150-day moving average. So if you were just to look at how far above or below the yellow line, the ratio line, gets from its 150-day moving average, this is one of the most extreme readings on record, meaning home builders are so bad relative to utilities. Now take a look. This is a time frame of 10 years. Look back even further. Now this is going back 20 plus 30 years. So it's not about the level, forget that. It's not about where that yellow line is. It's the yellow line's relationship to the moving average, the blue line. How far above or below the blue line can the ratio line, the yellow line, get before you snap back or collapse? And that's the point. Home builders are so bad that they're good, and utilities are so good, I think, that they're bad.
It's interesting. So quickly on that, I hear what you're saying without question, and we're talking about now a few standard deviations away from the 150-day moving average. But can this rectify or correct itself with utilities coming down in a meaningful way and home builders sort of going sideways?
Yes, or home builders popping here a bit because they're overdone and utilities just going sideways. But either way, I think that goes to the heart of it, just what you said, Guy. It's not how it's resolved. It's the question is it inevitable that there will be some resolution? I think so.
All right, let's talk about it because we got a main event coming here. And I mean, the way you heard us when we started the conversation, Carter, earnings season is going to be a big test for this market. I think the fact that we are kind of weakening the market overall as we kind of head into Q1 earnings season, I think, again, I don't think the quarter just passed is going to be that impactful for a lot of companies. Maybe bank stocks. I think one of the things that really stuck out in JP Morgan's Q4 report were higher expenses. That stock gapped down it closed down 6% after a gap after their Q4 report in mid-January or so. That was probably the biggest one-day gap in move after earnings going back a decade. When you think about the setup here, Carter, we've had some underperformance in the bank stocks, even as lots of the parts of the market had rallied off of the March lows here. What's your take, holistically, when you think about the setup into earnings? And I know you want to drill down on some names.
Sure. So the first thing is that there's something called conventional wisdom, right? A convention is something generally agreed upon. And there's nothing wrong with conventionalism. That's why it's conventional. Most of it's right. But conventional wisdom sometimes is actually deadly wrong. And we know that conventional wisdom has been you want to own banks because the NIM or net interest margin is going to be good with the rates going higher. And it's been anything but. Banks have been terrible, even as rates have gone higher and higher. So let's look at a couple of charts just to put that in context. Here we have the first one, which is, I believe it's a ratio chart again. And what you're going to see is the relationship between the XLF and the SPY. Again, we're just taking XLF, and you can do this with any instrument. You do the Coke versus Pepsi. You do it McDonald's versus the whole stock market. Doesn't matter. But it's XLF's relative performance to the SPY. The notable thing, of course, is if you really want to get frank, financials have never recovered from the financial crisis. So there they are in 05, 06, when they plunge in 08. And then even though financials make new highs, it's the dilution, There's 50 times more shares outstanding in AIG and Citibank than there was then. They can never regain those losses, shockingly. But let's look at a bank. Let's look at Wells Fargo. We have some charts here. And this is Wells Fargo. I would call it a pair of twos. It's kind of slumpish the way Microsoft is slumpish. It doesn't look like it's going to crash, and yet it's lost its way. It's not in an uptrend. It's sort of just muddling. And yet it's all about relative. If you are a portfolio manager benched against a sub-industry group if you're running financials. Do you own insurance versus banks, brokers versus online brokers, et cetera, and so forth? So here's Wells Fargo, and now look at the relative of Wells Fargo to the BKX, which is the next chart. It's making, almost right now, making new 52-week highs. And so Wells Fargo, a dud, kind of not interesting, but its relative performance, if we were choosing to Wells versus Citi, Wells versus JP Morgan, now there's alpha, and that's what that chart projects.
Yeah, no, and I think that, for some reason, Wells is kind of caught a bid. Maybe it was a valuation situation. I know that the regulators have been all over them for years now. Some of the other money centers have acted very, very poorly. And it's funny, you're using the BKX here, and it's really hard. That XLF is such a wonky ETF when you think about the fact that, and Guy brings this up all the time, that the largest component is Berkshire Hathaway. They got to get rid of that thing. They make it more of a kind of pure play. But, one of the things that, I often look about, like as we head into earnings and you look at poor relative performance in a group like this that could be really important, I say to myself, if I own these things, how might I kind of get some protection, right, into what could be a volatile period? Or the flip side, if the other case presents itself. But one of the things that's really interesting to me is if you thought the bank stocks could really get things going lower and to the downside, if that S&P gap gets filled and then we have just a really murky outlook. We already had that annual letter from JP Morgan CEO Jamie Dimon a couple weeks ago, which was not particularly optimistic. So if you have a situation where on the micro, their expenses are still high, the NIM's not great, all that sort of stuff, and the guidance is bad, that thing's going down. And now between now and next Friday's close, we're going to have maybe 40% of the XLF report. And sometimes I say, what are some cheap looking options? And you can talk about cheap or expensive in options, whether it be dollar cheap or in volatility terms. In this case with the XLF, if you look out to next week, April 22nd expiration, with the ETF trading at about 37.89 or so, that 37.50 strike put, okay, is offered at 40 cents, about 1% of the ETF price. So let's just think about this, right? Let's say you're long JP Morgan, let's say you're long Wells, and maybe a couple other things in the XLF. If you're looking for short-term protection to pay 1% between now and then with a kind of a funky market, that makes some sense to me. I just wanted to throw that one out there. Guy, thoughts?
No, listen, I'm with you. I think this is a great risk-reward trade right here. And you've been all over this. The banks, Carter said it, and you just alluded to it. Banks should be, well, I shouldn't say that. Everybody seems to think banks should be trading well. In retrospect, it's not happening at all. And maybe the way to trade this is wait for the JP Morgan numbers, Dan. A lot of times you'll see an initial pop. Maybe you'll be able to buy these puts even cheaper, and then we'll see what happens on the back end. But I like this a lot. And, banks are not impervious to what's going on as well. We have a couple questions before we get out of here. I just want to answer them quickly, Dan, and you have some thoughts on this. XLV, that's obviously healthcare. I think it's trading around 143. One of the questions is, it's been a monster, very defensive. Is it time to pull the ripcord? I think it's actually making a new all-time high either today or late last week. I want to say you stick with it. I'm inclined to say, though, that the disciplined thing to do is take some profits. We have another question about the IBB. I think it's trading 130. It bounced from sort of the 122 level. I will tell you that 122 to 125 level was a prior all-time high back in February of 2020. Past resistance becomes support. Feels like we're going to test it again. So again, when I say nothing's impervious, Dan Nathan.
Yeah, fact. I mean, the XLV is kind of interesting, Guy. It did reverse. It did make a new all-time high on Friday, and now it's down a couple percent or so today. That looks like a big double top. Maybe Carter will weigh in on that. And then on the IBB, I mean, I really think that, I think Carter threw that into one of his montages last week, is that kind of, bearish to bullish reversal here. And from a technical standpoint, I think that one makes some sense, especially if it can kind of hold in here. Carter, thoughts quickly on those two?
Yeah, I mean, healthcare has underperformed for so long, almost 6-7 years, and it is defensive. I think it is maybe the single best sector to be overweight. IBB, the exact opposite. It's so bombed out and not performing well that I think the bearish to bullish reversal is intact, and one should be long as well.
And I think the IBB is predominantly, I want to say off memory, it's Amgen. I think Gilead is second. I think Vertex is in there. They threw Moderna in. So those are, I think, your top 4 or 5 names in terms of the IBB. So obviously you got to look at those individual stocks. But I started this show, Carter, by saying we're going to put 30 minutes on the clock. I'm looking at my make-believe watch, and it is 1:30. So I want to thank you, as always, for joining us. Carter Braxton Worth of Worth Charting. Want to thank our sponsors, FactSet and Open Exchange. I want to obviously thank Dan Nathan. I mean, I don't have to thank him. He's my compadre, as they say. He's my partner.
Yeah,
we'll be back tomorrow at 1 o'clock, won't we, Dan?
Yeah, we will. Hey, and listen, you know what? I've been actually getting a lot of emails and tweets about where can I find Charter's Worth? You see what I did? Charter's work there. So you can get at Worth Charting. I mean, go figure it out, man. You know, hit Kim up. He's got all the charts. He's doing them every night. So we appreciate you, man. Thanks for joining us. Carter Braxton Worth of Worth Charting.
Thank you. Bye, guys.
Later.